If you are looking to invest in different countries or industries, you have to create a sort of a scoring system in order to measure their individual attractiveness. And there is no universal tool that fits the best for all preferences. You just have to collect relevant attributes or requirements that fits to your attractive market definition and design a scoring system on your own in order to compare individual markets. Just imagine choosing between investing in China, Russia, Germany, USA, or some other country coming from emerging markets, for example. It's not just about market size, GDP growth rates, number of people, or available resources. It's a mix of many aspects focused on assessing earnings, potential, and its dynamics, risk exposure, investment range needed, available targets and market saturation, general rules of the game, etc. Here, different analytical tools might help you in order to collect ingredients for your decision-making process. PESTEL analysis, industry life cycle, 5 forces, HHI, and similar. Usually, they follow a top-down approach from a macro environment through industry or sector analysis and competition analysis on a specific market to assessing an individual company's attractiveness. Let's explain. Especially in cross-border deals, PESTEL analysis is the first framework used to assess market attractiveness. Within a country, it has less importance in general, but certain aspects have to be taken into consideration as well, especially in cases when potential targets come from another sector. PESTEL is used to create a general understanding of a market outlook and conditions relevant for business, and it is usually a first filter to decide about your preferences, either to explore more or let it go. PESTEL is the acronym for the following aspects: political, economic, social, technological, ecological, and legal. Political. Here is the point to understand political risks relevant for your potential business endeavor. In less stable countries, expected elections might be a slowdown sign, or war in Ukraine caused Western companies to exit Russian market while opened doors for new entrants coming from BRICS, Middle East, or some other countries. Economic. Here is the point to understand the volume of an economy by measuring its GDP, analyzing growth drivers per industry to predict how potential economic prosperity will influence different industries, and similar. Keep in mind that economic studies are available for the countries, although their predictions do not have to be accurate. Note that certain industries are very vulnerable to economic cycles, for example, construction, and financial investors avoid them in general. Social. Here is the point to understand demographics, wealth distribution between classes, geographic distribution, culture, and similar. The main goal is to predict and assess how social changes and habits will affect selected industries. For example, in UK and Nordic countries, gambling online is more popular compared to visiting gambling outlets, while at Mediterranean countries is still dominant land-based business model, although COVID-19 helped the transition to omni-channel business model. Technological. Here is the point to understand available technological infrastructure and potential inflection point caused by a lag behind between the most advanced countries, from the standpoint of technology, to others, meaning to predict the dynamics of spreading technological advancement in follower type of countries. Just mentioned gambling example is useful case here as well. Ecological. Here is the point to predict and assess how changes in ecological requirements will affect selected industries, where by ecological, we usually mean pollution, waste, and climate change. For example, war in Ukraine caused gas supply obstacles in EU, causing increased interest for coal, lowering ecological standards, and opening doors for dirty industries to raise again. Legal refers to a wide range of elements like labor, environmental and consumer regulations, taxation, ownership, competition, corporate governance, and similar. Keep in mind that certain industries might be heavily regulated, while for others, liberal rules might be applied. In general, here is the point to understand rules of the game. As mentioned before, PESTEL is a good tool to make a rough conclusion, either to keep exploring some market or to ignore it. If you decide to explore more, usually the next step is to estimate market volume, its structure, and what is its stage of development at the industry life cycle. The point here is to understand a long-term growth potential and the right market entry momentum. It is always nice to have a proper market research and in-depth market analysis, but in general, it depends on your stage of market entry development strategy. Either you are still at rough market analysis and data collection phase, or choosing between a few. You can always rely on public market reports for rough estimates. For example, you can find data coming from relevant industry associations, annual reports from publicly listed companies, and similar, where you can find useful data per country, market segments, and similar. For example, here are the estimates for gambling industry in EU, coming from annual report from OPP, Greece Gambling Champion. Yet, the point is to get deep market understanding, including the stage of industry life cycle, because it will significantly influence the decision-making. For example, seed capital and early stages of industry development are usually supported by local wealthy individuals, business incubators, and local VC funds, not global players. Simply, early stages of development are characterized by a low level of market penetration, since there is a low industry awareness, high technological uncertainty, and probable high capital needs in parallel with suffering from probable losses. Global players will usually wait a bit longer until they can find more predictability and identify future champions. Growth stage. There is an acceleration of market penetration as product technology becomes more standardized and prices fall. In this stage, strategic partners will most likely look how to enter the market. They will either acquire existing local champions in order to take over prime locations, sound brand, and know-how, or they will decide to enter organically, meaning to launch their own operations, especially if they are the owners of a global brand and know-how. While it is still a young market, so there's no reason to pay someone for market entry when you can show up and destroy the competition. On the other hand, financial investors will have a slightly different approach. They will look for the way to position themselves on time and close the market for new entrants. That means to acquire a local champion, or to acquire a few more companies and create one of the local leaders, and wait for the right strategic partner to come and ask for a prime market entry opportunity. Gambling industry in the EU is a great example of a growth stage of development. Technology, omni-channel development, and regulatory changes are the key drivers for double digits at sales growth, causing a huge wave of M&A transactions throughout Europe during the past few years. If you look at the history of Entain or Flutter, you will see that those companies, nowadays known as prime strategic partners, are created on a set of M&A deals and financing coming from London Stock Exchange, not wasting their time on organically developing operations and geographic coverage. Or, you can see that some other champions in Central Europe are PE-backed, for example, Sazka, Fortuna, Superbet, etc. Or, you can check recent activities of large PE funds like CVC, Blackstone, and similar. They all have, or had, their own stakes in this industry, waiting for the right moment to make the exit. Simply, while others create cars, chocolate, phones, or something else, meaning products or services, PE funds create or upgrade entire companies. Maturity stage is characterized by different rules. There is increasing market saturation, and demand growth is slowing down until reaching the level where demand is caused by a replacement. Here, you already have well-established market champions. They are very profitable with stable growth rates, usually just a few % per annum. Although you are allowed to enter these markets organically, in reality, these markets are already occupied and closed for new entrants. A good example refers to Western companies entering Eastern Europe in 90s. They are all focused to acquire well-established champions through a process of privatization, not to compete from scratch, meaning entering organically. Financial investors play a significant role here as well, but they are usually focused on two types of deals. LBO, meaning to use a lot of debt in a transaction if they find a proper target, as explained before. Further market consolidation, to act as a market consolidator, acquiring few companies in order to reduce number of players and additionally improve market position, or to create a regional platform, attractive for some non-present global strategic partners. Decline is the next stage of development. It happens when the industry becomes challenged by new industries that produce technologically superior substitute products. Here, strategic partners usually leave the market because they cannot create profits any longer. On the other hand, some financial investors might find this attractive, to acquire a company and sell it in pieces, especially if it is asset-rich. As you can notice, we have already mentioned a lot about competition intensity, market concentration, its saturation, and similar. On top of industry life cycle, at least two more tools are used in analysis: Porter's 5 Forces and HHI. Porter's 5 Forces framework is static in nature, from time perspective, and it is focused on industry structure and dynamics between existing players. It is focused on a relative power between the players and their earnings potential. It pays attention to the following factors: industry competitors, competitive rivalry. Higher the competitiveness, less attractive industry. Since the companies are fighting for the same group of customers, they are willing to reduce their prices in order to sell. In general, level of rivalry depends on competitors' concentration, industry growth rates, capital needed, and importance of fixed costs, level of differentiation, and similar. Threat of new entrants. Easiness to enter the industry influences the degree of competition. If the threat of new entrants is high, existing competitors will most likely reduce prices in order to decrease the possibility of new entrants. Most common barriers to entry are scale and needed experience, access to supply and distribution channels, legislation, or some specific advantages like technology, control over raw materials, locations, and similar. Threat of substitutes. Substitutes are products or services that might be used to satisfy the same need as the industry's products or services, but have different nature or characteristics. For example, desk computers are substitutes for a laptop. Substitutes might reduce demand for the product or service coming from the industry. If the substitute will affect the industry, that usually depends on price-to-performance ratio. Power of buyers refers to relative power of potential buyers over existing companies within industry. For example, power of retail chains over beer producers. The power of buyers depends not just on their scale and their available number, but how easy they can switch from one supplier to another if they can produce the products by themselves, and so on. Power of suppliers refers to relative power of potential suppliers over existing companies within industry. For example, raw materials, equipment, and similar. Just like the power of buyers depends not just on the scale and available number of suppliers, but how easy they can switch from one buyer to another if they can sell to end users without intermediaries, and similar. As mentioned before, industry attractiveness is measured by the level of profits that the companies within an industry generate. High level of competitive rivalry, powerful buyers and suppliers, threat of substitutes, and possible new entrants will all squeeze profitability out. Both strategic partners and financial investors will avoid industries with high levels of competition, or where all players are already in struggle. Yet, strategic partners have less choices. Sometimes, they have to follow their competition and enter some markets, even if they don't like it, just to stay in the game and put a pressure on the competitor. As a supplement, HHI is also used in practice. The term HHI means the Herfindahl-Hirschman Index, a commonly accepted measure of market concentration, or saturation. The HHI is calculated by squaring the market share of each firm competing in the market and then summing the resulting numbers. If there is only one player, HHI will be 10,000 points, as 100 squared. In practice, markets with HHI between 1,500 and 2,500 points are considered as moderately concentrated, while markets where HHI exceeds 2,500 points are considered as concentrated. If you are an investor, most likely you will avoid those markets, except in cases when you have the opportunity to acquire a market leader dominating the competition, or when the market is at a very early stage of development, and that is the reason for high concentration. On the other hand, when HHI is low, an organic market entry strategy might make more sense in general compared to an M&A opportunity, especially in cases when you're offered to acquire some smaller players. However, financial investors might find this very attractive. They start buying and merging companies in order to consolidate the market and create a dominant player. To sum it up, it's all about you and how you are going to play. As an investor, most likely you are going to create a list of desired requirements that make a market an attractive opportunity for you. And PESTEL analysis will be your first filter to make a short list. Next, through industry lifecycle, Porter's 5 Forces, and HHI, you will define your primary targets in terms of countries and industries. Next task, to assess individual companies' attractiveness.